Well, good evening, ladies and gentlemen, and welcome to Gresham College. For those of you who don't know me, I am not Robert Barnes. I'm Michael Mainelli. I am the former professor of commerce here, emeritus professor of commerce, one of the trustees and fellows. And it's a real delight for me tonight, such a delight that I decided I'd dress up properly for the occasion. But actually, it is in many ways slightly in honor of tonight's speaker, Robert Barnes. Dr. Barnes and I share something in common, which is that we have both been chairman of Broad Street Ward Club. And whilst I was swanning around today having lunch with the Lord Mayor at Broad Street Ward Club and greeting him in morning suit, Robert, unfortunately, was on a plane coming in from Taipei, and so was unable to partake of various refreshments, which many of us did this afternoon, which is why my introduction will be rather short. But seriously, it's a delight tonight because I've often wanted to make sure that when we talk about commerce, you've got my kind of very vague and confusing lectures, but I'd like to have people who really are deep in the heart of what's going on in the city today. And Robert and UBS, as you can well imagine, have been at the heart of what's been going on in the city. Robert in particular has another thing in common with me, which is that he got his undergraduate degree at Harvard in mathematics and science. And he then moved on to get a PhD at Cambridge, and he joined the prop trading team at Swiss Bank back in 1994. So he's got real experience, both downstairs trading on life and also upstairs in the management suites and the boardrooms. But what I think particularly qualifies Robert to talk about tonight's lecture, which is the future of EU and global markets, is that what has been troubling the markets really for the last 4 years has been liquidity. And Robert and the UBS team have made a number of strides in trying to look at new ways of introducing liquidity into the markets. So Robert comes here not just as the managing director of the equities area, but also as the CEO of MTF, which for those of you who don't know, but you will know by the end of this hour, stands for Multilateral Trading Facility. And Robert will talk, therefore, about what they're doing, some of the innovations that they've done, why they think that a number of what seem to be purely commercial initiatives could well help the markets in the longer term and resist some of the stresses that have come about since 2007, and why things like dark pools may be things that save all of us. So with no further ado, Robert, who unfortunately is not here in full dress kit, but has got a far better lecture than I. Robert, thank you.
Well, thank you very much, Professor Mainelli, Barbara Anderson. I'd like to thank Gresham College for inviting a humble practitioner to address such a distinguished audience. Ladies and gentlemen, I remember a few years ago actually coming to a number of lectures at Gresham College. I remember Brian Williamson, a former chairman of Life, the derivative exchange, giving a fabulous lecture. In fact, as our Professor Mainelli was mentioning, I started off as the lowest of the low scrub yellow jacket on the Life floor, running around with all the hand signals, learning about how markets worked. And what's happened over the last few years is that mathematics, electronic trading are now become the namesake of how we trade in the markets. I've also had the great privilege to participate with the Chartered Institute for Securities Investment. And ladies and gentlemen, if you are part of the CISI, welcome. You are getting professional development credit tonight. Well done. And in the last month and a half, there have been a number of significant gatherings taking place in Asia. In the middle of October, there was the World Exchange Congress, which I was invited to chair. And just last week was the 50th anniversary of the Taiwan Stock Exchange anniversary seminar, in which they had CEOs from Tokyo, Korea, Hong Kong, Vietnam, Thailand, and a number of exchanges. Also this year, you might recall, is the 100th anniversary of the founding of the Republic of China. So there's a lot of things to celebrate in this year, especially 2011. So ladies and gentlemen, since the brochure was actually published, I've almost totally rewritten the entire event because so many things have happened. So tonight, we will share with you a whistle-stop tour with what's happening in terms of the developments of global trading, but also the increasingly talked about interoperability of how we clear and settle instruments. And let me just start by giving you the answer in terms of what has actually been discussed in the last week or so. Number one, the fact that the world, when we talk about globalization, equity trading of shares has the potential to go global. And the insights that we learned from markets like foreign exchange, developed currencies, trade 24 hours, but they settle in one place, CLS Bank. Futures and derivatives are moving towards 24 hours. For example, the main index in Korea trades not just in Korea, but linked through Chicago 23 hours a day. And in the last few weeks, Brazil, Russia, India, Hong Kong for China, and South Africa have announced that they will be cross-listing their index futures, again, moving 24 hours. So the opportunity is also to look at products like exchange-traded funds and the traditional shares to also trade 24 hours. And the way that could be enabled is if we have an evolution also of the clearing and settlement. And Europe shows the way. Interestingly enough, financial reform is in the press. The key insight is that countries have no legal obligation to harmonize rules with one another. But what we are seeing are that leaders are standing up and voluntarily echoing very similar language at bodies like the G20. So we'll talk about some of the insights. But there's also an opportunity for asset managers that are looking to save the cost of duplicating the legal and documentation cost by calling for a global passport regime. So you can launch a product in one country and sell it in another. And of course, the other big theme that's being discussed is the whole over-the-counter derivatives landscape and how regulatory forums trying to put them into central counterparties, but also potentially electronically trade them. So ladies and gentlemen, the insight for us is to try and identify which products and trading strategies may have more affinity with an exchange model. So let's start by setting the context of the size of the markets. And when we take a look at the far right of this first slide, and you see that 625 number circled, the big number we often hear about in the press is $600 trillion of over-the-counter derivatives. Now let's put this into context of open interest relative to turnover. So if we have one apple, I've got an open interest of 1. But if I buy an apple, I sell an apple, and I buy an apple, that will be a turnover of 3. So this $600 trillion we often refer to refers to the open interest of over-the-counter derivatives. Now just to compare that with some other asset classes, the 91 to the right of that 90 to $100 trillion is the size of the fixed income bond markets. Then to the next of it, the 80 trillion is the size of the open interest in listed exchange-traded derivatives. And then to the right, 44, that 40 to $50 trillion, that's the size of the capitalization of the equity markets worldwide. Now, if those are open interests, let's take a look at trend of growth, and particularly if we look at the growth of over-the-counter and on-exchange traded derivatives. While the numbers are very different, 600 versus 80, it's interesting to note that the shape of the growth of the open interests over time seem to have been growing, perhaps suggesting that the wholesale markets that trade the over-the-counter derivatives may be hedging on the exchange landscape. But particularly interesting is look at the top right, that 80 trillion of open interest on exchanges is actually turning over $2,000 trillion of notional trading. Compare that with the bottom right of that 600 trillion of over-the-counter derivatives turning over about 1,700 trillion. So what's the insight? Why are the smaller numbers on exchange turning over so much more? Well, there's a few explanations. One is, for a lot of the fixed income products, they're often traded on exchange in little Lego blocks of strips and packs and bundles. But the main reason is that the on-exchange products tend to have a short time to expiry, and we tend to have to roll those contracts to maintain exposure. Of course, many of the over-the-counter derivatives may be multi-year in nature when the interest rate swaps might be initiated. But if we wanted to take a look at the segmentation of over-the-counter derivatives we've read in the press, there's a great snapshot from the New York Times in October 2008. This is just after Lehman had its default in September. And if you look at the big bubble, you can see that the light blue circle, over 2/3 of the activity in over-the-counter derivatives are in interest rate products, like interest rate swaps. Then you've got the credit default swaps, a significant bubble, and a material minority of over-the-counter equity derivatives. Now, if we look at the right series of bars, you can see a significant escalation and growth trajectory of the credit default swaps. Once those products really got standardized in 2003, we saw an increase dramatically of activity. So standardization seems to be associated with increased activity. What about geographic segmentation? Look at the far left. You'll notice that 80% of over-the-counter derivatives are in Europe and America. Now, 20% in Asia. But actually, if we take a look at Europe, 60% of the global open interest is in Europe. In fact, 2/3 of the European activity are associated with UK. Really, that is the City of London. So when we see that there's a lot of regulatory reform taking place, the key insight is if we want to understand where the direction of global reform is going, if we understand predominantly the European and the US regulation, we should have a good idea of what's happening elsewhere. Now, what actually happened? Look at the top left. Here we've got two dealers, wholesale dealers, facing off to each other in the over-the-counter markets, and then they each are servicing C, the clients behind them. And if one of them has a supernova, kind of like Lehman going down, the other dealer is open to significant bilateral counterparty risk. And on the far right, the solution the regulators are suggesting is, why don't we introduce a circuit breaker, a central counterparty, CCP? But that central counterparty, to manage the concentrated risk, will ask for some extra capital. And with that extra capital or margin, on the bottom left, you might see that costs are going higher, but then at the bottom right, whenever there's complexity, there's opportunity, potential for new products and competition and other types of relationships. So what's actually happening in terms of the G20? Well, we've just had a meeting recently in Cannes, but what I'd like to share with you are the foundations of where we are going in terms of the G20. And it all took place really in September 2009 after the April meeting here in London, where they actually clarified that they wanted over-the-counter derivatives to be standardized, to be traded electronically where appropriate. And by the end of next year, 2012, all of that has to be done. From a transparency point of view, they're going to create these trade repositories. So whether or not over-the-counter derivatives are put into a central counterparty or not, they must all be in these repositories. And if a product is not put into a central counterparty, there will be higher capital. That is the tool the regulators have to try and shift business in a certain direction. And the G20 have asked the Financial Stability Board, the FSB, to actually set the pillars within which we can behave as entrepreneurs. And in fact, if anything happened in June 2010 in Toronto, really the regulators wanted to speed up the process. So what are the pillars? There are really four. Standardize the product, mandatory central clearing, trade them electronically, and transparency through these trade repositories. And if we look at the key regulation to understand, in July of last year, we had the enactment of the US regulation called DoddFrank. Then we had in September of last year the proposal of the European EMIR legislation, which is currently going through its discussions now. And interestingly enough, in October last year, IOSCO, which is the International Organization of Securities Commissions, set up a task force on over-the-counter derivatives. And isn't it interesting to see the co-chairs? Yes, the USA, CFTC, and SEC regulators, the UK FSA here, but also SEBI of India. And in Seoul, last November, 1 year ago, there were a number of interesting insights. The key one was that Basel III, this capital requirements directive, will be enacted. Really, the insight is capital is going up. To do business as we do it today, it will cost more in the future. But particularly interesting was that Seoul was the first time we had a non-G8 country hosting a G20 meeting and inviting a number of member states that are not traditionally members of the G20, including countries like Switzerland, Spain, Singapore, Hong Kong. Interestingly enough, the insight is that the regulation from a macro-prudential point of view wants to be inclusive. When we take a look at the scope of the regulation, Dodd-Frank in the US is really covering three areas. trading, clearing, and reporting. The European approach is bifurcated. So the clearing and reporting is covered by this regulation called EMIR, and MiFID II is talking about trading and transparency. And broadly, what does this mean in a picture? Well, up on the top left, you can see the clients dealing with the dealers, and there are two ways to interact. OTC, over the counter, traditionally getting on the phone or electronically doing bilateral activity, or on an exchange where you have the meeting of buyers and sellers. Now, majority of these over-the-counter products will be put into that green horizontal bar, the clearinghouse, and everything will have to be put into that blue bar at the bottom, a trade repository. Some participants early on in this process stuck up their hand and said, would it be possible for us to get exemption from mandatory clearing? But increasingly, because the majority of product will probably go into the clearinghouse, people are beginning to link trading liquidity with the process of the post-trade. And therefore, people realize that maybe it does make sense to get into that standardized clearing framework. Now, here in the UK, we've also had the privilege of meetings with a number of asset managers and the regulator. And asset managers have raised the following observation. Some asset managers today initiate these over-the-counter trades, maybe for hedging purposes, with banks using a credit line. But tomorrow, if that product is put into a clearinghouse for mandatory clearing, the CCP will ask for cash or cash equivalent from terms of margin, that cushion capital. Some asset managers observe that their assets may not be cash or cash collateral. And if they have to put up margin, there are two questions. One, how much might this margin be globally? And secondly, where will they get it? Well, we've seen a huge range of estimates, and the most prudent number is something like $200 billion globally, up to maybe $2.5 to $3 trillion. So even the most prudent estimate of $200 billion of new initial margin is a significant amount. The next question is, where will we get it? Well, the answer is it'll come through the repo markets, and I think people are just beginning to realize they also need to take a look in that dynamic. Of course, the other key buzzword that we're reading about in the newspapers is this SEF, S-E-F, a swap execution facility. This is particularly a term in America referring to the legislation of DoddFrank that says if we have a product that is mandatorily cleared in a central counterparty, it must be traded on an exchange or electronic order book or a swap execution facility, whatever that might be. If that swap execution facility looks like an exchange order book, interestingly enough, it'll be pushing everything onto exchange. Now, Chairman Gensler of the CFTC has been very public in his comments. Yes, he wants dealers regulated. He wants mandatory clearing of these OTC products, but he also likes the idea of having as much of this traded on exchange as possible. Why? Well, one insight is that if you have a price, you have a value which allows you to impute the calculation for margin. But what lessons can we learn from the European experience, and particularly from equities? Well, in Europe, we've had since November 2007 this MiFID regulation, the biggest regulation since the Treaty of Rome in '57. MiFID stands for Markets in Financial Instruments Directive. Some people think it stands for Many Investment Firms Find It Difficult. And what it covers really is trading, clearing, and reporting, but interestingly enough, the role of MiFID was also to try and enhance the competitiveness of Europe relative to other regions, and specifically by promoting competition in those layers to reduce the frictional cost to increase liquidity. But interestingly enough, in 2008, this table is showing the values traded in dollar-adjusted terms worldwide on all the exchanges. The top left, $120 trillion of value was turned over on exchanges worldwide in 2008. What's interesting? That was an all-time record for equities. And even though we were suffering one of the biggest crises in the history of the capital markets, in the equities world, where we had exchange, clearing, and settlement, everything seemed to perform very well. So the insight is that regulators are being informed by the experience in equities. And if we take a look at this next chart of, say, 20 years worth of data on the x-axis, on the y-axis, the trillions of dollars that are being processed regionally around the world, you can see, yes, the peak and bursting of the internet bubble around 1999, but overwhelmingly, values traded on exchanges have continued to grow, and particularly recently with the introduction of the newest generations of electronic algorithmic trading. And one of the aspects that have been very important by the European framework has been a harmonized framework of transparency. Let me give you an example. Pre-MiFID, pre-November 2007, all the member states in Europe did not have a harmonized reporting regime. So for example, if in UK we were on the phone trading a block of Vodafone, those Vodafone shares within 3 minutes we had to manually type and send a report to the London Stock Exchange. We also had to pay the London Stock Exchange that report. We had to pay to get the market data back. We had to pay the vendor the data. We kept paying for our own data, but it was all in the same post-trade data feed with the on-exchange business. In Germany, however, if we traded Daimler over the telephone, well, it was considered over-the-counter and not obliged to be reported anywhere. In fact, Deutsche Börse was estimating 40 to 50% of nearly half of all of German equities. Nobody had a clue what was actually going on. So the regulator said, right, we're trying to promote competition, so all firms must report, but firms are no longer obliged to report only to exchanges. So what we decided to do as an industry to avoid the risk of people just reporting to websites and other places was we created a vehicle called BOAT. BOAT is a vehicle where we centralize all the data in one place and then have it in one particular data feed. Now, we started with 9 firms and no activity on 1st of November 2007. Today, you can see on the far right, we have over 40 participants, including a number of multilateral trading facilities reporting, and we've captured about a quarter of all of the on and off book data. In fact, the bank consortium of BOAT actually sold to Market Partners, a company that's an expert in data. And interestingly enough, Market has provided this data from the reports going to BOAT. And here's an interesting insight. If you look at that black line in the middle, 50%, what it's telling us is that half the trades that are being done in equities, over the counter, reported to BOAT, are of large enough size to be eligible for regulatory delay. The logic is, if you do a big trade, you want a bit of time to unwind the risk before the rest of the market knows about it. So the regulators have said, fine, if you are beyond a certain threshold, you are eligible to delay the report. But here's the interesting behavioral insight, right? Half the value is large enough to be delayed reporting, but look at the orange triangles. Only about 10 to 20% really are delayed. So that blue circle at the top, you have 80% plus of this data feed, including lots of big chunky trades, are actually being reported in real time. So the key insight is that post-trade transparency can be pre-trade transparency for the next trade. It's contributing to the price formation process. And there's another dynamic that's happened with the electronification of order books. Those of you that may recall, it was October 97 that the London Stock Exchange went from telephone trading to moving the blue chips onto the electronic order book. And what's interesting, from 1999, remember, 99 was the peak of the internet bubble, the all-time high of the FTSE index, which has been lower ever since. From 99 to 2008, look at the far right column. The value up to 2008 grew 6 times in value. But interestingly enough, the middle column, which shows the number of trades, has actually gone up 35 times. Why are the number of tickets rising much faster than value? The answer is in the left column. £63,000 per trade used to be the size of an average bargain in London in 1999. Today, it's less than £10,000 per trade. Because the cost of processing trades increasingly relates to the number of tickets, and that's mainly because the post-trade clearing and settlement costs count the number of clicks. Ladies and gentlemen, if we do nothing about this trend, it will cost us more year on year to process the same value of flow. But we'll come back to this one in a minute. The key insight, and Professor Manelli mentioned this at the beginning, is the far right. Today, worldwide, on-exchange order books, value traded is some 30% lower than where we were at the peak. But there's another interesting insight. If you look at the regional breakdowns of Asia Pacific and Europe, ladies and gentlemen, since 2009, the first time since modern records began, Asian exchange order books are now doing more turnover than European ones. So let's take a look at some exchange initiatives. And in fact, what was very topical in Asia was the fact that perhaps there should be more focus on cooperation rather than consolidation. We've had a whole raft of various exchange initiatives announced. In fact, I counted just a few. We had Australia and Singapore, that was blocked. We had Russia, MICEX, and RTS. Actually, that's going through. We've got BATS and Chi-X Europe. That looks like that's going through. We've got London Stock Exchange and TMX of Canada. That was basically withdrawn. NYSE Euronext and Deutsche Börse. We're about to hear some news about whether those two markets will get together. But during that period, we also had the counterbid by NASDAQ OMX and ICE jointly trying to go for NYSE Euronext. They withdrew that. And potentially, if you've been reading the Wall Street Journal today, there might be an announcement tomorrow about Tokyo Stock Exchange and Osaka getting together. Those are some examples of exchanges getting together, but increasingly exchanges are talking about cooperation. Now, earlier this year, an independent survey was published highlighting the fact that 7% of exchange initiatives are highly successful. Of course, the insight is 90% fail, right? So what is it about exchange initiatives that are successful? There are two features. If they are successful, they are really successful, and number two, increasingly, they tend to have a flavor of internationalization. So we've got movements like markets like Bursa Malaysia, which are looking to get recognition in different regulatory regimes, linking up in partnership with CME. In fact, Bursa Malaysia sold 25% stake of its derivatives arm and has a dollar palm oil contract, its core contract, actually trading on Globex and CME. But also, as a result of their improvements to become attractive to international investors, they've also been rewarded by upgrade to advanced emerging status by FTSE, the global index company. Let's take a look at futures. Eurostoxx future. 1999 it launched, there was no activity. Today it has grown to the most liquid future in Europe. And what's interesting about it? It's a multi-country product. If we look at cash equities, look at the far left, January 2008 on the y-axis, billions of euros that are actually processed. You see two bars, the blue and the yellow bar at the left. If one was to ask the question, ladies and gentlemen, what are the two largest single order books in Europe as of January 2008? The answer is the largest two single order books are single country order books. They are UK names on the London Stock Exchange, German names on Deutsche Börse, etc. But ladies and gentlemen, look at the middle of the chart by January 2010 and every month since. The orange bar, the largest single order book in Europe, is now a multi-country Europe, Chi-X Europe, that admits for trading all the different names across Europe. And believe me, this insight is not lost on markets in Asia. What's interesting is a number of stock exchanges in Asia, for example, Tokyo, Thailand, and others, are only allowed to trade stocks that are listed on their platform. Whereas here in Europe, we have this concept of admission for trading. So whereas a stock may list on an exchange, and the exchange has the obligation that if that company has a profit warning, it has to issue a press statement, not only does the platform admitting for trading not have that obligation, one also does not need permission of the company to trade the stock symbol. And that allows a lot of innovation in this direction. But London Stock Exchange itself also has a significant international offering called the International Order Book. And if we take a look at this chart, from January 2009, this new segment, which is trading depositary receipts, mostly Russian depositary receipts today, represented about 4% of LSE's order book activity, and within 2 years, it's doing 16%. That's up 4 times in 2 years. Now that is truly remarkable. But ladies and gentlemen, you may know, but others in London are still surprised to learn that the most liquid single stock name on the London Stock Exchange is no longer a UK name like Vodafone or Rio Tinto's. It's Gazprom, a Russian depositary receipt. In fact, the top 4 most liquid Russian depositary receipts are in the top 20 most liquid names in London. And of course, what's interesting about that is the blue chip index in the UK is the FTSE 100. Remarkable. You'll also note at number 27 of this snapshot, we also saw a line for an exchange-traded fund. We'll come to that one in a minute. But what's very interesting is this case study about the largest bank in Russia, Sberbank, which this year decided not to list a depositary receipt in London. Instead, it did an American depositary receipt. But London Stock Exchange had the ability to admit it for trading. And at the end of its first day of trading in London, it was the third most liquid name on London. Interesting. So what is the insight? Well, there are a few. The first is investors are motivated to trade risk, even if it's in a slightly different time zone than the home market. Second observation, if you have the ability to trade in terms of trading, clearing, and settlement that international investors find easy and competitive, you will find activity. So progress is motivation plus ability. But we also come back to exchange-traded funds. Now here's a snapshot in 2008, just after the crisis. We look at the full year value traded of, say, UK and Italian equities, the solid bars on the left, being lower in 2008 than 2007. But you'll notice on the right, the value traded of the listed exchange-traded funds on the order book of the exchange actually higher. Now, one insight is that as Lehman went kaboom, many investors were interested in mitigating broker counterparty risk. So if you trade a product on exchange and it goes through a clearinghouse, you can do that. Of course, this is coming from a low base, and if we actually take a look at the growth of underlying assets, here's a great chart from BlackRock. The asset manager has about 4 trillion of assets under management. You can see the dramatic growth of assets under management in these products of exchange-traded funds. But what's remarkable about exchange-traded funds? Well, in the United States, the most liquid ETF is the SPDR, the S&P 500 index tracker, and you might say it's the most liquid share in the world. But really, the irony of the term exchange-traded funds is that outside of America, these products predominantly trade over the counter. So, ladies and gentlemen, if you are an exchange and you're thinking about growing liquidity because you're 30% or more down from where you were in the peaks, and only 7% of your initiatives are actually successful, which next product has a higher probability of success? Well, ETFs seem to be growing assets under management. They're over the counter. If we can get them onto the order book, that might help contribute liquidity. And interestingly enough, if you have the fund and you could admit for trading the underlyings, we know there are participants that are sophisticated enough that just want to trade the mathematical pairs that would increase liquidity. Now, we've also got some interesting examples. The Russian Titans are a popular product. They are listed on NYSE Euronext. Euronext is the combined French, Dutch, Belgian, Portuguese shares. But it's interesting that this Russian ETF listed on Euronext actually refers to the underlyings that are trading on the London Stock Exchange. So you can see a bit more globalization of these products. But we're also seeing some calls for global passports. So BlackRock has this great example. They have 2 products. The codes on Bloomberg are FXC and FXI. They are both mathematically tracking the FTSE A50 China index. One trades in America, one trades in Europe, but today they're not fungible, and that splits liquidity. So why not have a global passport? Another interesting insight is this product EEM. This is an emerging market equity fund, and this product continues to trade even when the European emerging countries are sleeping. What's the insight? The insight is investors want to diversify their risk by geography pretty much any time of the day. So what about exchange order books and the evolving market landscape? Well, we've got 2 charts here. At the top, we're looking at the shape of the capitalization by regions, Americas, Asia Pacific, and EMEA. And the key observation is that even though the Americas are a bit higher in value of companies, capitalization, you'll notice that the shapes are broadly the same. These are like the index levels moving together. But at the bottom chart, we see a significantly higher light blue Americas line compared to the regional European and Asian markets. And this is the turnover value that's actually being processed on the exchange order book. This is associated with the maturity of the newer high-frequency strategies that are very present in the United States. Now, countries like UK, France, and Germany have seen a surge of activity on their order books when some of these new strategies appeared. What is interesting is that, as we said, since 2009, Asian exchanges are recording more order book value than European ones, and yet this is before the appearance of a lot of these high-frequency strategies. Aside from Australia and a bit in Japan, these have yet to appear. Very interesting. If we wanted to take a look about the story of China, everybody's interested in China. This is the next two charts, very interesting. The pink line is showing us the value of companies listed on Shanghai, and we compare that to international markets like Tokyo and London and see how they're all broadly converging together. But if we look at the value traded, you'll notice that recently Shanghai has actually surpassed the order book turnover of international developed markets, London and Tokyo. In fact, Shenzhen, another exchange in China, also is doing more turnover. And if we take a look at 2010, remember 2008, 120 trillion, 2010 we're down to 70. If you look at the bottom right, you can see Shanghai and Shenzhen. Shanghai about 4.5 trillion of turnover, Shenzhen about 3.6 trillion, compared to only about 3.8 trillion of Tokyo, and London about 2.7 of on-order book activity, very significant. The other interesting insight is if you add up all the value in Europe and you compare it to the value in Americas, you will notice that Europe is significantly less. Now, many countries realize that the governments cannot afford to pay the social security net of pensions. That's why it makes sense to privatize it through the financial markets, and therefore integrity and efficiency of the markets are important for the structure of how they work. But the observation was very interesting. Why is the US doing so much more turnover than Europe? Well, there are a number of reasons, but one is the high frictional costs of trading, clearing, and settlement in Europe relative to the United States, which is why regulators have been using the tool of competitive new entry to reduce those frictional costs. Now, ladies and gentlemen, for those of you that are familiar with order books, here we have, at the top left, RWE, a well-known German power company. And you can see the bids in blue, the offer prices in red, and the sizes in white. So the way to read this is, someone might be willing to bid 78.61 for 1884 shares, at the best bid, and someone at the best offer is willing to offer 10 shares at 78.62. Now let's talk a little bit about transparency and availability of activity. Here in RWE, right, it's a well-known German power company, the total value available to buy and sell is about 20,000 shares. Now this is a company that trades about 2 million shares a day. What's interesting is on this particular day we took a snapshot, 271,000 shares out of 2 million matched in the closing auction in the last few minutes of the day. What's the insight? I mean, that's more than 10%. The insight is that investors are not posting all of their liquidity, all of their order flow intraday on the order books. Order books, lit order books, are very efficient in providing certainty, but they suffer market impact. Interestingly enough, that's not just a German phenomenon. Look at the bottom right. Here we have a snapshot from Korea, and we can see on the x-axis 5-minute chunks, and on the y-axis the percentage of daily activity. And you can see at the far right a big spike right at the end. In fact, ladies and gentlemen, in the last 2 years, we've seen the value, the total daily value that is being matched in the closing auction in countries like UK, France, and Germany double. In fact, some stocks are trading something like 20% of the entire day's value of the stock just in that last minute of the day, mainly to try and mitigate signaling risk and market impact. So let's talk about the European market landscape. Now, some people say I have to prepare you for this slide, but I'm sure you can take it. This next picture is a simple picture of Europe, right? So what we have here are the various country exchanges on the top row. Then we've got some clearing houses in the middle row. So we do thousands of trades on the exchange. They match in the central counterparty, which nets them down to one net buy or one net sell per stock per day. And at the bottom row, we have the exchange of asset for cash in the settlement layer. Now, for those of you with eagle eyes, will note the date, April 2004. This was the date that the Markets and Financial Instruments Directive, the regulation text, was published ahead of its go-live date in November 2007. And remember, the tool the regulators were using to reduce frictional costs was the promotion of competitive new entry. Well, the consequence of competition might be innovation, but it's also fragmentation. And this is what it looked like just after MiFID. Ta-da! Right, well, ladies and gentlemen, it's complex. But do not be afraid, because technology can manage this, right? So how do we do that? Well, we notice that while volumes may grow if the world is more efficient, we're going to need new tools. And tools like smart order routing to interact with all these activities will be required. Those that are competent are going to win the order flow. That's the prize. So in addition to tools like smart order routing and a significant technological investment to manage this, we're also seeing the emergence of this buzzword, dark pools. And really, dark pools are nothing more than order books, where the firm order prices are not displayed pre-trade, but afterwards they are reported. So remember, lit order books, the traditional exchange order books, we get certainty, but may suffer market impact. The dark pools have no certainty pre-trade, but they do have high confidence in confidentiality. So immediately you can see there are two potential tools we can use to optimize for best execution. So what does a smart order router actually do? Here's a simple cartoon, right? We've got the same stock. It's trading in two different markets. So one's a blue market and the other is a green market. The smart order router is able to do two things. One, it's able to integrate for a consolidated view or awareness of the consolidated data at the bottom. But more importantly, on the right, it can seamlessly interact with the different physical pools of these different platforms to get the best result for end investors. Now this is a cartoon. Here's what it really looks like. So if we take a look at Bloomberg, right here we have an example of ING, a Dutch bank. And at the top row in white, you will see the key of various exchanges. So NA stands for NYSE Euronext, right? The French, Dutch, Belgian, Portuguese markets. IX is Chi-X. That's a new multilateral trading facility that's multi-market. It's now become the biggest single order book. TQ is Turquoise, another MTF. BATS is EB, and others. And the way to read this is at the left side, we have the consolidated pre-trade transparency, and on the right side, we've got the post-trade transparency. So at the top, the best bid is 6.585 for 2755 shares. And you'll notice at the far left, NA, that is NYSE Euronext. The second best bid, also at the same price for 1980 shares, is IX Chi-X. And if you look at the far right, while the best bid is at the home market of NYSE Euronext, the second best offer for 2338 shares is TQ Turquoise. So you have multiple different platforms, but we can see a single holistic order book. Now on the right side, we've got the post-trade transparency. So we see the timestamp of 9:24:19 seconds. The execution venue was Turquoise. We traded 1,263 shares at a price of $6.59. And you can see the different timestamps and the different venues in this consolidated view. So the vendors are actually doing the electronic consolidation for us, pre and post-trade. And of course, it's not just Bloomberg. Reuters also has some tools. But really, the terms that people are now using is called direct execution to solve two puzzles. One is to manage this complexity of the market, and the second is increasingly to satisfy that subset of users, those high-frequency users that may have latency-sensitive strategies. And the two types of implementation, one is DMA, direct market access. That's where the investor can actually control the execution themselves, or algorithms where the end investor will give discretion to the framework of the mathematical algorithm for the discretion to actually work into the different markets. And the way it's evolved is the traditional phone order that used to go to the sales trader at the broker, who actually might have had a terminal from the exchange and manually typed it in to send that order to the exchange, has actually evolved through this FIX, is this language that's now the language of deploying orders into order management systems that feed the trading systems into today's fast, low-touch pipe, electronic direct execution, which just goes straight in. Now, with the appropriate systems checks, you could actually argue in some cases this direct execution can be safer. And the ways to get orders into the markets have also provided lots of choice. So we've got lots of different ways. The brokers can give a tool. You can have third parties build front-end tools. The clients can build their tools to access into a single front-end and route it into lots of different exchanges to get all of these fills. And what does it look like? Well, here are a selection of different examples. I mean, UBS has a few pictures on the left. You can go to third parties like Bloomberg or TT. And you can enter these orders for single stocks, so you can see the prices and put in your different algorithmic benchmarks. But you can also put in portfolios of stocks, multiple stocks, all in a portfolio in one go. You can access and respond to information like news or other types of analytical data. Increasingly, people are looking cross-asset class to do not just what they call the shares, which people refer to as the cash equities, but also the derivative products like the futures and the options. And algorithms themselves work with a range of order types. The two types of orders are placing a limit order, the price you can see, and waiting, or to see a price and actually grab it. So things like market orders, immediate or cancel or fill or kill type orders. But what's very interesting is how the algorithms themselves have evolved, right? The very first algorithms were the structured algorithms, the volume-weighted average price. I start at point A, I finish at time B, tick, 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 tick. I work through the order, very structured. And then they evolved to become reactive. So let's say I want to be in line with volume 3% of the market between 9 and 11 in the morning. So if the shares of the market are going up and down, well, my order will go up and down in shares. But the most recent, the most interesting, the most dynamic are the proactive liquidity-seeking algorithms. And these are the ones that have awareness and access to the different choices of the various lit order books and the increasingly new dark pools to provide a best result on a continuing basis. And of course, what's very interesting is that heterogeneity of investors actually contributes to very healthy price formation. And different investors use different tools. So the traditional long-only pension funds might want 80% of their activity on the phone with a sales trader and a little bit of the algorithms. When you get down to the passive index trackers, they might mostly be using computers to actually deploy their orders. And here's kind of a traditional model where the clients are giving their orders to a big firm, and that firm will access all the different markets and deliver the clearing and settlement. But as the world becomes more complex, ladies and gentlemen, not everyone can keep up with the cost of the technological arms race. So now what we're seeing are new models where brokers are becoming clients of other brokers. And what's very interesting in this picture is you can see the broker in green retains the ownership of their client relationships. And the other bigger broker is really just providing a much lower cost to access the markets, but also to use the state-of-the-art algorithms. I mean, for example, in our house, I think the remarkable story at UBS is over the last 15 years, we've grown from a respectable market share, and then thanks to the clients, to become the biggest trader of equities in the world. And really, thanks to the clients voting with their feet. But interestingly enough, other brokers can now get access to the same algorithms. The same algorithms are getting updated every week. And of course, there's lots of different implementations of how this might work, lots of tools. We're seeing that various providers are actually certifying the algorithms, so from an exchange point of view, they know it's safe. And you can also link it into the clearing and settlement of the underlying client, because they may also have custodial relationships in order to settle. So the key observation is the landscape at the top, all those flags. We used to have one market per every country in Europe. In addition, we're getting all of these new entrants in the second tier. But you can now plug in once and get access to all of these markets in one step. And that's in the cash world. And what's interesting is that as other markets, developing markets, reform themselves to adopt market best practice, market efficiency, which enhances liquidity, these markets also get added onto the drop-down list of these algorithms to seamlessly provide access to the international investors. And that's just for cash equities, right? We also have one plug-in, you get access to all the derivatives markets. The world is really scalable once we go electronic. Now, for those that would like to understand a little bit about the mathematics of these machines, here's a very simplistic cartoon. So on the y-axis, we have the number of orders the machines are actually sending to the order book of the exchange. And on the x-axis, we have this term edge. It's a Sharpe ratio, kind of risk-adjusted profitability measure, and a very simplistic elasticity of demand curve. Now, the logic is, let's promote liquidity. Why? Because more liquidity should minimize the implicit costs as the bid-offer spread comes in. That should be good for investors. And in order to trade, there's a vertical dotted line X. That's the minimum acceptable threshold, which means to the right of that vertical dotted line, you see a small area under the curve. There's a small number of economically rational orders to make To the left of the curve, there's a much bigger area. There's a much bigger number of orders we could send to the exchange that would just be loss-making. Now, the intercept on this line is Y. So Y are the number of orders we're sending to the exchange. So, ladies and gentlemen, the opportunity is to work in partnership with the exchanges and the regulators to see what can we do structurally to move that vertical threshold to the left. Because if we do that, without any additional human interaction, we immediately get more orders to the order book, enhancing liquidity. And as we've looked at various markets around the world that have successfully implemented a number of these developments, we start to see three particular themes starting to always appear. Number one, optimizing the front-to-back tariffs. So when we look for signals, and sometimes these signals are single-digit basis points in size. 1 basis point is 1/100%, right? And we look at the fees of processing, these explicit slippage costs. If we can reduce the trading, clearing, and settlement front costs, the ratio will immediately increase and we can send more orders. Number two, enabling off-order book activity to complement on-order book activity. When we trade on the exchange order book, it's seamless, but we also have increasingly the ability of brokers to use their own systems to cross buy and sell client orders off order book and report them to exchange or some other transparent reporting vehicle. And we find that complement also helps increase liquidity. And then the third is to offer a choice of central counterparty, particularly as we internationalize the markets, to bring together the nodes of different users to actually resonate activity. And many exchanges that are successful share key features. So in addition to the electronic direct execution, they tend to be anonymous of broker identifiers. They tend to have closing auctions. It's interesting to note that today, Hong Kong Stock Exchange does not have a closing auction. Istanbul Stock Exchange does not have a closing auction, right? Russia and MICEX does not have a closing auction. But I promise you, within the next year to 18 months, they will all introduce closing auctions because they're an important liquidity point. Crossing on and off the order book, using own systems with no minimum size threshold. It's interesting to note that the majority of countries by number today do not allow brokers to cross off the order book of an exchange. But the majority of value traded worldwide happens on markets that do allow this behavior. Interesting. Also, derivatives to help manage the risk, securities lending because you like to have on-time settlement as well as yield enhancement, tariff transparency, and choice of clearing. So key messages, right, let's try and improve the front-to-back tariffs, enable the off-order book to complement the on-book, and have a choice of CCPs. And what's very interesting is if we come back to this original picture, coming up to the finale, ladies and gentlemen, right, what we can see is on the right we said value has been growing on the order books. Now, by the way, isn't this interesting? In the London market, these are London Stock Exchange statistics. From 2000 to 2003, we had a bear market. We've had with MiFID all this extra fragmentation and competition. We've had stories of big chunks of blue chip market share moving away from the LSE. We've got brokers doing crossing off the order book. We've got these third-party dark pools, and yet the London Stock Exchange has grown 6 times. Isn't that remarkable? In fact, if we were to compare with, say, Johannesburg Stock Exchange, which is also a very efficient market, also uses the same technology as the London Stock Exchange. During that period, the growth has only been about 4 times. And in South Africa, the index has been going up, whereas in the UK, the index went down. Normally, you have a correlation of increasing activity when the index goes up. So really, the UK has been outperforming. And what's the difference? In the UK, we have many more choices of ways we can actually execute. That brings international investors together to resonate. But ladies and gentlemen, we said the big insight is that the number of tickets are rising faster than value. And if we don't do anything about it, it will cost us more year on year to process the same value flow. So what is the answer? Ha-ha! Here we have a nice colored picture. This is the summary of the European landscape that's beginning to evolve a choice of central clearing. This was the third point we said. So let's try and just read this slide, because this is a chart that the Asian markets are looking very closely at, right? So down the left side, CC&G is the Italian central counterparty owned by the LSE Group. EMCF, the Dutch facility. Eurex Clearing, Deutsche Börse. EuroCCP, the Americans DTC. LCH ClearNet, a single corporate entity, limited to UK, SA France, Oslo Norway, 6X Clear, Swiss. Across the top row, LSE is the London Stock Exchange, NYSE Euronext, all the way down to Burgundy. You'll see the ones in colors, Chi-X, Turquoise, Bats, Burgundy. These are the new multilateral trading facilities that have appeared in the last few years. that are also multi-country. Then you've got Euro Millennium down to Pipeline, including UBS MTF, these are the dark pools. And then you've also got platforms like SecConnect Securities Lending. Now, the way to read this chart, if we go under the London Stock Exchange, you'll see next to LCH Limited a word live in blue. You'll see next to 6X Clear a word live in blue. What this means is that we can trade Vodafone shares on the LSE. And we have a choice to clear it either in LCH or XClear. Now, isn't it interesting? Look to the right of turquoise, the Swiss exchange. Under the Swiss exchange, we also have LCH Live and XClear Live. Look under UBS MTF. We've got actually Euro CCP Live, but also XClear Live. So what does this mean? Let's just take the example of XClear. This means we could trade Daimler shares or any of 15 country markets on UBS MTF and clear an XClear. The next time we trade Nestle shares on the Swiss exchange and clear an XClear, it's cheaper, volume discount. Next time we trade Vodafone shares on the LSE and clear an XClear, it's cheaper, volume discount, right? So the consolidation of clearing of cash equities allows us to consolidate the number of tickets that we're doing, even if they're from different shares, for a single volume discount. Now, let's just put this into context, right? A few years ago, we used to pay 65 cents, euro cents, to clear, say, a Dutch equity in ClearNet. Today, you can come onto UBS MTF, and if you're a medium or big-sized player, you're likely to get it for about 1 at the margin, right? And that's not just at UBS MTF. That's now been catalyzed through all of the markets that you can add up. But ladies and gentlemen, the real advance that we're expecting to happen in the next year is the choice that, as it expands, really multiplies at the settlement layer. So let me give you an example. Where we have the same stock that trades on more than one platform. So I've got Vodafone traded on the London Stock Exchange. It's listed LSE. It's admitted for trading on Chi-X, admitted for trading on Turquoise. Today, those 3 platforms do not share a CCP. So that means of all the trades on each of the platforms, they net down to 1 message per settlement. That's 3 net settlement fees per stock per day. But when we, as a per firm, can choose 1 central counterparty, overnight we've just cut 2/3 off the settlement bill. That's a significant multiplier effect. Now, why is this so interesting in Asia? So in Asia, markets like India have 2 exchanges, right? So if we trade 98% of our activity on, say, the national exchange, and we trade, say, 2% on Bombay, and they still net down to 2 messages, if we could have a choice of clearing and put it into 1, you just cut half off the settlement bill. If you look at the ASEAN markets, right? So you've got Thailand, Malaysia, Indonesia, Philippines, Vietnam, Singapore, right? They're thinking about linking their markets together. If we could also consolidate their clearing, then you've got a market size of 600 million population, 1.8 trillion, right? And you've got countries like Taiwan, Korea, Japan thinking, that might be interesting to get involved. This could be very interesting. This implementation of clearing choice technically is very easy to implement. I'm just going to finish off with a case study on UBS MTF. And this received quite a bit of positive press, thank you very much, from the Financial Times and some of the others, about the fact that once UBS MTF introduced a second central counterparty, we were actually able to increase our activities. Probably better to show it on this next slide. Here we've got a time series at the bottom row from October 2010 every month, and then up through the top row up to the end of September. Now, UBS MTF launched in November 2010. And today it has grown to over 3,000 stock names on 15 countries, and we can settle every stock into its respective home country across the 15. But what's interesting is with all of the growth that we've had, that blue line shows us there's about 15 or 16 of these dark pools in Europe, roughly about 9 all the way through, and you can get to June. Now when we go from June to July, if you look at the number 560 to say 1274, we've significantly increased the activity in July. What happened? Well, those of you that remember the markets, we had a spike in volatility. And with spikes in volatility, you have a correlation of increasing on order book activity, whether it's dark or light. So we had our all-time record of value traded on UBS MTF in July, and we're still ranked only 9. Why? Well, because a rising tide lifts all boats. But at the end of July, we added in a second central counterparty, and the next month we jumped to 4, then we jumped up to 2. And that's been a very interesting insight. That's the only kind of variable that's changed relative to the other platforms. So the insight's moving in the right direction. Now, some have asked, what does a dark pool look like? Right? If it's dark, you can't really see anything. Here it is at the top left. This is what it looks like. In fact, this is the post-trade transparency. Now, The snapshot from Bloomberg just happens to be dark, right? But in fact, this is very transparent on a post-trade basis. So while pre-trade, the price is not shown, every price post-trade has got a timestamp, a size, and a price, and you can see in the red circle the actual code of the market identifier, the MIC code, the market identifier code XUVS. And you can see at the far right that big arrow jumped up as soon as we added in our second central counterparty. The other interesting insight is at the bottom right, you'll notice 3%. That's about the total value of turnover in the dark in Europe, right? In fact, today it was about 3.2%, right? So less than 5% of all the value traded is actually happening in the dark. So what is the insight? Ladies and gentlemen, if we have a choice of execution, where we have the lit order book that gives us certainty but might suffer market impact, but a dark pool that might not have certainty but gives us high confidence and confidentiality, we have an extra knob on the radio dial to try and promote liquidity. So the key message is, if we can work, ladies and gentlemen, in partnership with the exchanges to try and promote liquidity new business, and we thank the regulators because they provide the framework with which we can behave as entrepreneurs, we have some optimistic future. Ladies and gentlemen, I thank you very much. Thank you.